I've spent my entire adult life thinking about how to invest properly, and I'll tell you something that might surprise you. This worshiping at the altar of diversification, I think that is really crazy. Now, before you turn this off thinking I've lost my mind, let me explain what I mean, because this is probably one of the most important things I can tell you about building real wealth. Most people today, they're being told to buy index funds, buy ETFs, spread your money across 500 companies or 1,000 companies or even the whole world. And on the surface, it sounds sensible, doesn't it? Diversify. Don't put all your eggs in one basket, reduce your risk. But here is what nobody tells you. When you buy an ETF, when you buy an index fund, you're not reducing risk, you're guaranteeing mediocrity. Let me tell you why. When you own 500 companies through an index fund, how many of those companies do you actually understand? How many of those businesses have you studied? How many of those management teams do you trust? The answer is probably zero, maybe one or two if you're lucky. So what you're really doing is you're buying hundreds of companies that you know nothing about, have no opinion on. And frankly, if someone offered to sell you directly, you'd probably say no. When you mix raisins with turd, you still have turd. That is an old saying of mine, and it applies perfectly to index funds. Sure, you're getting some great companies in there, maybe 50 or 100 really wonderful businesses, but you're also getting 400 pieces of garbage. Companies with no competitive advantage, companies in dying industries, companies with terrible management, and you're paying for all of it. Now, let me ask you something. If you went to buy a house, would you buy 10 houses at once without looking at any of them? Just to diversify? Of course not. You'd be insane to do that. You'd pick one house, maybe two. You'd study the neighborhood. You'd check the foundation. You'd make sure it was a good house at a fair price. But for some reason, when it comes to investing, people think they should own everything. The good, the bad, and the ugly, all mixed together. I remember back in the 1950s and 60s, Warren and I, we were reading everything we could about investing. We started with Ben Graham's ideas, the cigar butt approach, buying cheap companies. But over time, we evolved. Once we'd gotten over the hurdle of recognizing that a thing could be a bargain based on quantitative measures that would have horrified Graham, we started thinking about better businesses. And you know what we learned? A great business at a fair price is superior to a fair business at a great price. That was the key insight. Quality matters, not just price. So we started focusing on wonderful businesses, businesses with competitive advantages, businesses with pricing power, businesses that could compound for decades. And we didn't need 500 of them. We needed maybe 5, maybe 10, maybe 20 at most. You should remember that good ideas are rare. When the odds are greatly in your favor, bet heavily. That is the opposite of what index funds tell you to do. Index funds say spread your money equally across everything. Don't concentrate, don't bet big on anything. But that is not how fortunes are built. Let me tell you about See's Candy. When we bought it back in 1972, we paid $25 million for it. People thought we were crazy. It was expensive by the old Graham standards. But you know what? When we bought See's Candy, we didn't know the power of a good brand. Over time, we just discovered that we could raise prices 10% a year and no one cared. Learning that changed Berkshire. It was really important. That one investment, that one concentrated bet on a wonderful business has made us billions of dollars over the decades. If we had just owned it as one of 500 companies in an index, the impact would have been negligible. We would have gotten the market return, nothing more. But because we concentrated, because we put meaningful capital into a business we understood, we got extraordinary results. Now here is what the index fund crowd will tell you. They'll say, Charlie, most people can't pick stocks. Most people don't have your expertise. Most people should just own the market. And you know what? For most people, that is probably true. Conservative investing and steady saving without expecting miracles is the way to go. Some people in this room can figure out how to average twice the rate of return. I can't teach everyone else to do it. It is pretty difficult. But here's the problem. If you can learn to think properly, if you can learn to analyze businesses, if you can develop the discipline to wait for the right opportunities, You absolutely should not settle for market returns, because market returns include all the garbage, all the overvalued companies, all the mediocre businesses, all the companies that are going to go bankrupt or struggle for decades. Why would you voluntarily own those? I don't think anyone should buy a bank if they don't have a feel for the bankers. Banking is a business that is a very dangerous place for an investor. Without deep insight, stay away. That is my philosophy. If you don't understand it, don't own it. But when you buy an index fund, you're owning everything, including all the things you don't understand, including all the things that are terrible businesses. Let me tell you what happens over time with index investing. You get exactly the market return minus fees. And those fees, even if they're small, they compound against you over 20, 30, 40 years. Those fees can cost you a fortune. But more importantly, you're missing the opportunity to do better. If you can learn to identify wonderful businesses, if you can learn to buy them at reasonable prices, if you can learn to hold them for decades, you can beat the market by a wide margin. Warren and I, we've been doing this for over 60 years now, and we haven't beaten the market by being diversified. We've beaten it by being concentrated. We've beaten it by knowing what we own, by understanding the businesses deeply, by having conviction, view a stock as an ownership of the business, and judge the staying quality of the business in terms of its competitive advantage. That is the key. You're not buying a piece of paper. You're buying a piece of a business. And if you're going to own a business, you better understand it. Now, let me address another argument the index fund people make. They say, Charlie, active management doesn't work. Most mutual funds underperform the index. And they're right about that. Most mutual funds do underperform. But you know why? It is not because stock picking doesn't work. It is because most mutual fund managers don't actually know what they're doing. They're closet indexers. They own 100 or 200 stocks barely different from the index. They're afraid to concentrate because if they're wrong, they'll lose their jobs. Everywhere there is a large commission, there is a high probability of a rip-off. The mutual fund industry is built on fees, on gathering assets, not on generating real returns for investors. So of course most of them underperform. They're not trying to beat the market, they're trying to gather assets and collect fees. But that doesn't mean you should give up and buy an index fund. It means you should learn to think for yourself. It means you should learn to identify the few managers who actually know what they're doing, or better yet, learn to do it yourself. Let me tell you about the cost of diversification. The real cost when you own 500 companies, you own mediocrity guaranteed. You're guaranteeing that you'll get the average return. But the average return includes all the winners and all the losers, all the great companies and all the terrible ones. If you could just eliminate the worst half of companies, you'd dramatically improve your returns. And that is not that hard to do. You don't need to find the next Apple or the next Amazon. You just need to avoid the companies that are going to fail or struggle. Knowing what you don't know is more useful than being brilliant. If you can recognize what you don't understand, if you can stay within your circle of competence, if you can avoid the businesses that are too hard or too risky, you're already ahead of the index. Let me give you an example. In the late 1990s, during the dot-com bubble, the index was heavily weighted toward technology stocks, wildly overvalued technology stocks. If you owned the index, you owned all of them. You had no choice. The index forced you to own the most overvalued companies in the most expensive sector. Warren and I, we didn't own any of them. People thought we were crazy. They said we didn't understand the new economy. But we understood something more important. We understood valuation. We understood that when something gets too expensive, you shouldn't own it. And when the bubble burst in 2000 and 2001, we were fine. We didn't lose 50% or 70% like the index did. That is the benefit of selectivity, of concentration, of thinking for yourself. Now, I want to talk about something that really bothers me about index funds, the free rider problem. Index funds don't do any analysis. They don't evaluate management. They don't vote their shares intelligently. They just buy everything in the index in proportion to market cap. They're free riding on the work of active investors, the people who actually analyze companies and vote with their feet. If everyone owned index funds, if no one was doing price discovery, the whole system would break down. Markets only work because some people are trying to figure out what things are worth, trying to identify overvalued companies and undervalued companies. Index funds are parasitic on that process. Now, I know that sounds harsh, but it is true. And more importantly, if you have the ability to think for yourself, if you have the ability to analyze businesses, why would you voluntarily give up that advantage? Why would you say, I'm just going to own everything and get average returns? That is intellectual laziness. Let me tell you about our approach at Berkshire. We don't own hundreds of stocks. We own a concentrated portfolio of businesses we understand. And within Berkshire, we own entire businesses, not just stocks, but whole companies. And you know what? That concentration has served us incredibly well. If you can buy a few great companies, then you can sit on your ass. That is a good thing. That is what we've done. We've bought wonderful businesses. We've held them for decades, and we've let them compound. We haven't traded in and out. We haven't tried to time the market. We've just owned great businesses and let time do the work. Sit on your ass investing. You're paying less to brokers. You're listening to less nonsense. And if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum. That is a huge advantage over index funds that are constantly rebalancing, constantly trading, constantly generating tax events. Now, let me talk about what I think is going to happen in the coming years. We're in a period where index funds have become incredibly popular. Everyone's being told to just buy the index. And you know what happens when everyone does the same thing. Opportunities emerge for people who think differently. Mimicking the herd invites regression to the mean. If everyone's buying the index, that means everyone's buying the largest companies, regardless of valuation, regardless of business quality. Just because they're big, that creates distortions. It creates opportunities. The companies that aren't in the index or that are small components of the index, they can get undervalued, really undervalued. And if you're willing to do the work, if you're willing to think for yourself, you can find those opportunities. We have a history when things are really horrible of wading in when no one else will. That is when the best opportunities appear, when everyone else is either panicking or blindly following the index. Let me tell you about temperament. This is maybe the most important thing for an investor. If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get compared to the people who do have the temperament, who can be more philosophical about these market fluctuations. Index funds don't teach you that temperament. They don't teach you to think about business value versus market price. They teach you to ignore price fluctuations because you own everything. But that is not the same as understanding that price fluctuations are opportunities. When the market goes down, that is when you should be buying more of wonderful businesses at better prices, not just automatically rebalancing into the index. Let me give you a specific example. In 2008 and 2009, during the financial crisis, the market went down by 50% or more. If you owned the index, you just held on and hoped it would recover. But if you were selective, if you understood businesses, you could see that some companies were going on sale at ridiculous prices. We bought into Goldman Sachs. We bought into General Electric. We made deals that have generated billions of dollars in returns. We couldn't have done that if we were just index investors. We had to understand the businesses. We had to have cash ready. We had to have conviction. Successful investing requires this crazy combination of gumption and patience, and then being ready to pounce when the opportunity presents itself, because in this world opportunities just don't last very long. That is not index investing. That is active thinking. That is understanding businesses and valuations. Now, I want to address the young investors out there, the people in their 30s, 40s, 50s. You have time. You have the ability to learn. You have decades ahead of you. Don't settle for index returns. Don't settle for being average. Learn to think about businesses. Learn to read financial statements. Learn to understand competitive advantages. It is not that complicated. It just requires work. It requires reading. It requires thinking. In my whole life, I have known no wise people who didn't read all the time. None, zero. You'd be amazed at how much Warren reads and how much I read. My children laugh at me. They think I'm a book with a couple of legs sticking out. That is what it takes, reading. thinking, learning. And if you do that, if you put in the effort, you can do much better than the index. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. They go to bed every night a little wiser than they were when they got up. And boy, does that help, particularly when you have a long run ahead of you. That is the approach. Continuous learning, continuous improvement, not just buying the index and hoping for the best. Let me tell you what I think the biggest problem with index funds is. It is not the fees, although those matter. It is not the tax inefficiency, although that matters too. The biggest problem is intellectual atrophy. When you own an index fund, you stop thinking, you stop analyzing, you stop learning about businesses. You just accept whatever the market gives you. And that is a terrible way to go through life, let alone to invest. You need to be engaged, you need to be thinking, you need to be learning. Otherwise, you're just a passive participant in a process you don't understand. And when things go wrong, when the market crashes, when your index fund is down 50%, you won't have any conviction to hold on. You won't understand why you own what you own. But if you own a concentrated portfolio of wonderful businesses that you understand deeply, you can sleep at night. You can buy more when prices are low. You can have conviction. That is the difference. Now, let me be clear. I'm not saying everyone should avoid index funds. For most people who don't want to put in the work, who don't want to learn about businesses, index funds are probably fine. But if you're watching this, if you've made it this far, you're probably not most people. You're probably someone who wants to do better, someone who is willing to put in the effort. And if that is you, then don't settle for index funds. Don't settle for mediocrity. Learn to think like an owner. Learn to analyze businesses. Learn to be selective. You don't need to own 500 companies. You need to own 5 or 10 wonderful ones. And you need to hold them for decades. Let them compound. Let time do the work. That is how real fortunes are built. Not by diversifying into everything, but by concentrating into quality. I succeeded because I have a long attention span. That is what it takes. Focus, concentration, long-term thinking, not the scattershot approach of owning everything in the index. So my advice to you is this. If you're going to invest, really invest. Don't just buy an index and forget about it. Study businesses. Read annual reports. Think about competitive advantages. Find 5 or 10 companies you really understand, companies you'd be happy to own for 20 or 30 years, and then buy them when the price is right and hold them. Don't trade. Don't try to time the market. Just own wonderful businesses and let them work for you. That is the path to real wealth. That is the path Warren and I have followed for over 60 years. And it works. It really works, but it requires thinking. It requires work. It requires discipline, things that index funds don't teach you. So stop worshiping at the altar of diversification. Stop settling for average returns. Start thinking like an owner. Start being selective. Start concentrating on quality. That is how you build real wealth. That is how you beat the index, and that is what I wanted to share with you today.